Welcome to the deep dive video update. And I always want to explain what I mean by deep dive. I do a number of different videos each week. I do a video each day. There's a number of weekly videos. This is a video where I look at hundreds of charts and I pick out those charts that I didn't use necessarily in the other videos, but they still could be telling us something. So it's meant to be more of a supplemental type video to complement the other videos that I post, especially the daily video update. There are also some additional charts here that are unique just to this video. So if you only watch this video, you're not going to get the real story of the analysis that I do. But if you do watch the other videos, this video could really help you to kind of fill in some of the gaps along the way. This is being prepared for Monday, October 28th. Before I get into that, there's a thing called the SPX Investing Program. It's a program that I have developed. It's up, it's going, it's free until the end of 2024. There are links below this video that can take you to the website or to a video that you can learn more about the program. If you have any questions, here's an email address where you can contact me. And as I mentioned, the daily video is really where I focus everything. The videos around the outside, this deep dive video, that's just one piece of the overall puzzle that I try to put together. But if you want to see things unfold on a day-by-day basis, the daily video is really the place to go. The first chart that we look at is more for information. It just gives us an idea of what kind of a range is the VIX in right now. And the VIX is on here, but it's invisible. Over top of that, I have a 50-period exponential moving average. And we're going up right now if you look over to the right-hand side, but we're still in a lower range. And that's typically what happens. When the market's going up, we're in a bull market. We've been climbing since October 2022. And that's when we started to see the VIX go down in the bigger picture. Now, we've been climbing lately. That's not what we're trying to measure here. We're just trying to see over a long period of time, is the VIX tending to be higher? That's when the market is going down. When the VIX is lower, that's when the market is going up. Then we look at this, and this chart here is shorter term, where we want to know how fast is the VIX actually moving. And this is measured by using a shorter term version of the RSI. And we look for an extreme positive or negative reading. We're not getting that right now. So that's really when I pull out this chart, is when we're looking extreme. Otherwise, I don't show this chart in the video. This was a chart until a couple of days ago. I was showing for like a week and a half. It seemed like 2 weeks, a long time. This is a correlation between the VIX and the S&P 500. And when we get above this red dashed line, that's when the market is appearing to be nervous. We may not be seeing that in some of our other VIX charts and VIX studies, but we were getting high readings for the VIX with the S&P setting an all-time high. And that's a very strange thing. And this chart picked that up. Well, since that time, we declined this past week and we've fallen down more below this dashed line right now. So I stopped showing this chart, but I was showing it there for quite a while. And I just call this part of the VIX studies. Another closely related chart is called the skew index, which is related to the VIX, where the VIX uses at the money options. The skew index looks at out of the money options. We were also up in this red area for a long time. Since that time, we've dropped back down, so I stopped showing this chart. But taken together, we were a little bit nervous about the market. And then we saw a decline, and these values ended up coming down. We also look at the VIX, and then there's a thing called the VVIX, the volatility of the VIX, and we just do a ratio between the two. And you can't really get much in the way of generalities other than usually when this is going down, that means the S&P is going up. Now, there are some exceptions, and we really haven't been moving all that much. But here, we've been going up lately, as the S&P, for the most part, has been going up as well. That's why I don't really show this chart all that much, because we have to look at it in the context of other charts. We look at the volatility of stocks as measured by the VIX, and then the volatility of bonds is measured by the MOVE index. And we had been seeing a lot more volatility. And when this is going down, that means stocks are less volatile than bonds. Because lately, stocks have been holding up fairly well, again, even though we had a down week. but bonds have been under pressure and interest rates have been going back up. And that was picking this up. And we're seeing things stabilizing a little bit as the value overall has been going back up. But what I really watch is the moving average. And again, it's hard to take some generalities from this, but typically when this moving average is going down, that means the S&P is going up. But there are some exceptions to that. We are going down now. The S&P had been doing well until this past week. We'll see if we can turn or keep going down with this red line. That would be more positive for stocks. The Ulster Index is another sentiment gauge that was developed really to use with mutual funds because they only have a closing value or a net asset value, also known by the acronym NAV. And we're below the moving average right now, even though we're kind of chopping around, coming up just a little bit. But really, I only show this chart when we get above the red line. Since we're below the red line, I haven't been showing that. Even though we're seeing a bit of a pullback right now in the S&P, the VIX is now back up over 20. We're not necessarily seeing that confirmed by this chart. And I usually show this in the daily videos as well, but we've been just kind of chopping around and not going anywhere. This tries to measure risk on, where folks are getting more into the growth stocks, versus risk off, where they're getting more defensive with what stocks are getting into. And we try to look for overall movements up or down. If we're going up, that's more risk on, and that's usually when the S&P is going up. When this is going down, that typically puts the S&P under pressure. Well, we're going up here, but we're just kind of chopping around lately. So I stopped using this for right now in the video. But if we start to see some kind of a definitive move, either up or down, I'll be returning this chart to the daily videos. We also look at a ratio between large caps and small caps, and really choppy because there are times in 2024 when the small caps have done well and then they seem to go to a high end of a range and then pull back. Well, the large caps have really been leading things higher. And if you go back over a longer period of time, as this is going up, that means the large caps are outperforming the small caps. So we can take a bigger look at this. What I try to follow here is just what's going on right now. And we are tending to go higher, but there's an awful lot of choppiness. It's not really giving us a lot of insight right now. So that's why I stopped using it in the daily video. But if we start, just like the previous chart, if we start to see some kind of a definitive move, either up or down, I'll be bringing this chart back as well. This is just for information. Just out of curiosity, how far above are we from the previous all-time high that was set in January of 2022? There's a little red dot or line right over here. That's when we set that high, and then we went into a very difficult time in 2022. Well, we've been bouncing back up since then. We have surpassed that previous high, and currently we're up 20.53% above the previous all-time high that was set. Stockcharts.com has this thing called technical alerts, and this is for the whole week, where I usually show each day's alerts in the daily video. And if they're interesting, I'll end up talking about them if they give us some kind of insight. See a lot of red on down days, see a lot of blue or green on up days. And this just gives us an overall visual look at, okay, if things are really red, that probably means we're going down. If they're blue or green, then we're probably going up, and we're seeing more positive things actually happening. Then stockcharts.com has another tool called the technical scores. Now, I use it for indexes, but you can use this for a stock, for a sector, for other indexes that I don't show here, just to get an idea of what's the general market climate right now. And the idea behind technical analysis is it's supposed to remove emotion, but it doesn't always do that, because you can get the same chart in front of 10 different people and they can come to 10 different conclusions. So there's a lot of confirmation bias that goes into even technical analysis. They try to remove even more emotion by ranking technical analysis scores on a scale of 0 to 100. The higher the score, the better looking that chart, without using any emotion. Well, what's interesting is the QQQs, which have done well in 2024, and then they hit their high back on July 16th, and they've really been lagging lately. Well, this past week, we're seeing what could be some positive things coming into the market for the mega caps and the NASDAQ 100, and here. with the QQQs. That's the ETF for the NASDAQ 100. And so it's coming in first place right now at 88.7. When a chart is really looking strong, we would get up into the 90s. So we're showing some improvement with this chart, but we're still not at that really strong stage yet. Then in second place is the S&P 500, which had been first for the last number of weeks because the NASDAQ 100, as its name suggests, has 100 stocks, and those are pretty much all tech stocks. Where the S&P 500, it has those 100 stocks, but then it has over 400 other stocks that are more diversified, that some of them are values, some of them hold up better, some of them are more established companies. It's not all just tech. And so when the market's a little bit under pressure, or the NASDAQ 100 or the NASDAQ are underperforming, the S&P tends to step in first place. Well, it's still doing quite well with a score of 86, but it dropped back. It had been in first place, now it's in second place. In third place is the Dow at 64.1. A week ago, it set an all-time high. But now that we're in the middle of earnings season, since there's only 30 stocks that make up the Dow, you get one or two components of the Dow that are having a down day and there's negative reaction to the earnings reports. It can really bring down the Dow itself. And there were a few days this week where the rest of the market was doing okay and the Dow was actually down, but it's coming in third place at 64.1. Then we're seeing a little bit of an improvement here, but small caps have been pulling back lately. You can see here's how this score has been going down. It's coming in fourth place at 60.3. And then in last place, which just is coming off of setting a recent all-time high, are the mid caps, but they're not looking all that strong right now, coming in at 52.4. Then I have a short-term chart, and what I show here, usually I only will show this in this video. Sometimes I'll include it in the what to watch video. This is a longer-term look at the short-term time frame. And what I do here is I plot a 10 period through 50 period moving average. So there's a bunch of lines and I change the color. So I call this a rainbow. And this just gives us a bigger picture look at the short-term time frame by just saying, okay, are we above all the lines? Are the lines continuing to go up? Now, we've been under pressure. It looks like we're declining right now, and that's all it looks like at this point. Things are still holding together. It doesn't look like we're switching over and actually turning negative as of right now. I'll have to see if things change after that, but I don't do forecasting. What I do is I just look at the charts and go with what's presented at this particular time. We did come back down a little bit into the top end of the rainbow, but we're still pretty high in the rainbow overall. Now, when we look at the 20 period moving averages, we're still above that. And that was tested twice this past week. In Wednesday session, we actually dropped below the 20 period moving average, but we're able to come back up and close above it. And then in Thursday session, that was the low for the session, was the 20 period moving average. So for right now, that moving average has been tested twice and it's succeeded. And so the short-term trend still seems to be intact, even though the market has been under some pressure. Intermediate term, another rainbow, going from 50 periods up to 100 periods. Even though we've fallen back, we're still well above all the lines in the rainbow and the lines are going up. So the intermediate term trend continues to be positive. And I haven't been showing the 50 period moving averages because we're still dealing with the 20 period moving averages right now. And since we're kind of far away from this, I haven't been showing this chart. Now, if we do see more weakness and we close below those 20 period moving averages, then this will be the next chart that we start to focus on because this is the intermediate term trend. Also, somewhat intermediate to a little bit long term is the 100 period moving averages. Also, well above all the lines, and the lines are going up. So there's been no need to show this chart. Standard deviation. This does not measure direction. This just says how is price deviating or moving. So it's measuring speed over the last 10 periods. And it's really dropping down. I usually only show this chart when we get above this blue line here, which is a moving average. The mass index, we only pay attention to this when we get up to the red dash line and the blue line here. We're far away from that, so there's been no need for this. The Pring bottom fisher, which is supposed to be the type of indicator that when we see a real decline, and then it looks like we're bottoming in that out of that decline, and then we use it with some other charts as well. to suggest, okay, maybe we're finished, we're establishing a base, and now we're going to go up from here. Well, we're not getting a signal right now because we're below the moving average. And this comes in and out of the video each day as needed. This measures the difference between the price of the S&P 500 and how far away we are from various moving averages, the 20 period, the 50 period, and the 200 period. And we use this like an oscillator. When we get too far away from the 20 period moving average, we get a really high reading from that because price has a tendency to slap back or be drawn back to the moving average. Right now, we're not getting any kind of extreme reading. We were week before last, but this has really come down a little bit. We've also come down with the 50 and the 200, but we're still above the midpoint with all of these charts, so we're looking positive overall. And I had been showing this for a while, but I have another chart that's very similar to this. This is an advanced decline ratio. This is based on 19 periods, so it's more short term. We actually dropped below the midpoint based on price, but we're still above the midpoint based on volume. So price is negative, volume is positive, even though the context is that we're going down right now. If we drop below zero with both of these, then I'll probably start including this chart again in the daily videos. This is longer term. This also tries to measure the internal strength of the market. This looks at the Amex, the NASDAQ, and NYSE and does a 5-period moving average of the highs minus the lows. Even though the market's been under pressure lately, we're still getting a positive reading with this indicator. So the broader market to this point is still holding up. Then what is the distance away from the 200-day moving average? Because sometimes when we get too far away from that we got really kind of far away here back in the spring, and then we saw a decline. Then over the summer, we got far away again. Then we saw a decline. We're not really at that point right now. If we get up 14, 15% away from the 200-day moving average, that's when we'll bring this chart out and actually start to show it. And then more for informational purposes, how much have we gone up since we hit the low in October in 2023? We're up 29.29% from that low to Friday's closing high. Now, I have another measure in here. This was when we hit the high in July, and then we started to see a more severe pullback than what we've seen at least to this point. And we got down close to that 10% decline. And that's when the definition of a correction happens. If we start declining more than 10% from the all-time high, which that's what this was at that time, then that's considered to be a correction. Well, we got close to that level. The smart money started to come in. This was that crazy day back in early August when everything was falling apart for about a day and a half. Well, the smart money started to come back in, do a lot of buying, push us back up. We had a little bit of a fallback, but now we've gone on to set new all-time highs. Connor's RSI is another momentum oscillator that I don't use all that much, except when we're getting an extreme positive or negative reading, which is not what we're getting right now, so I haven't been showing this. Anchored moving averages, which are different because they try to project forward, where regular moving averages, they look backward. And we're still not really declining all that much. We're above all the anchored moving averages that I have here, and all the lines are going up. So there's been no need to show this. If we do start to fall, we'll be looking to see if one of these areas will end up providing support. CMB composite, I also use this like an oscillator for an extreme positive or negative reading. Since we've been under pressure lately, this is going down, but we're not getting down to this black line at the bottom, at least yet. The percent B indicator, this goes hand in hand with Bollinger Bands, and there's lots of different ways you can implement Bollinger Bands. This is just one way right here. The percent B measures when we're above the upper or below the lower Bollinger Band. We're not there right now, so that's why there's been no need to show this chart. We're still tending to be positive, though, because even in the Bollinger Band itself, there's a midpoint, and we're still above that level. And that right now equates right around to the 20-period moving average. Then the Ichimoku cloud, which really all this is a series of moving averages that are calculated and then shifted forward on the chart. This is heavily used in Forex by some people. Well, the general idea is that when we're going up and we fall back, that one of these clouds may provide support. Now, it's kind of a wide area, but you can see that there's some validity to that. We fell below it, but then we're able to come back up into it. Now, I put the full study on this chart, which includes some additional lines. When the blue line is above the red line, we're still positive, and the green line, for the most part, has been going up as well. So, and we're well above the cloud. And if we do fall down, this is a green cloud. We changed from a red cloud to a green cloud now. So this chart is still looking pretty positive, but not really telling us anything new that we're not getting from other charts. Point and figure chart. We didn't have enough of a move this week because a point and figure, either X or O, is drawn when the S&P goes up or down by a certain amount, and that didn't happen. But when we look at this chart altogether, we're still looking positive. We're seeing a lot of X's. We're setting new highs here. We have these blue trend lines going up. And there was a double top breakout that was generated on September 19th. We're still working off of that. So this chart is still looking pretty solid. We want to keep an eye on the S&P 100 because it's the biggest stocks that make up the S&P 500. Not really seeing much of a disconnect. Earlier on, we were seeing the S&P 100 starting to underperform the S&P 500, and that's a little bit of a concern because the S&P 100 are like the mega caps, the really big companies. Now it's starting to take more of a leadership role. And so that's more encouraging, at least to this point now. But we're not seeing any real disconnect between these two averages. Okay, long term, we have another rainbow going from 50 periods up to 250 periods. This is the long term trend here. Even with the recent declines, we're still above all the lines in the rainbow, and the rainbow lines are going up. Another long-term oscillator is called Special K. And believe it or not, on the weekly chart, we're just about getting ready to cross above the red line. With all the move up that we've seen over the last, well, over 2 years now, that chart had never turned positive. Well, we turned positive back in late 2023 after going above it, going below it, going back above it. And we remain positive here. But since there's so few triggers that are generated by this chart, I don't show it in the daily videos, just if something happens. Then on top, we have a weekly chart of the S&P, a weekly chart of the DAX, because there's a pretty strong correlation between what happens in Europe and what happens in the US. And we're seeing that pretty strong here. This just measures the correlation between the top chart and the middle chart, Germany and the US. And it had been getting a lot weaker, but we're seeing some improvements, or at least more of a correlation getting stronger between the US and Europe right now. And this is the Fibonacci retracement levels where I go to the all-time high here. And there's been no need to show this chart unless we really start to decline. We'll be watching some of these red lines here, which are different percentage retracement levels. And then some broad market measures. This is the Vixen. This is the VIX equivalent to the NASDAQ 100. Going up, giving us kind of a high reading right now as stocks have been a bit under pressure. And we've been getting high readings with the VIX as well. Then we look at the S&P and then a ratio of the QQQs, which is the NASDAQ 100 and the Dow, but not really getting much. Correlation is neutral to slightly going in the opposite directions currently. The transports, which we have the Dow coming off of recent all-time highs, but the transports, that's the red area here. A little bit of an improvement here, but for the most part, just chopping sideways and not really getting close to setting an all-time high, at least again. The bank ETF doing quite well, but seeing some profit taking, but still above its 50-day moving average. And we also look at a ratio between the regional banks, the smaller banks, and the financial sector, kind of chopping around right now. We are in an uptrend here. We saw a recent golden cross with this ratio, but we're not really seeing anything all that definitive right now. So, but we're not seeing it fall apart either. So we're rather encouraged by that. Some rate of change charts that I use just for informational purposes. This goes back 250 periods. We're looking really solid. This is very long term. This chart also is very long term, and we're above this blue line. Sometimes we get concerned if we go above the blue line, because there's been other times when we come up, hit this, and then turn and go the other way. But we've been showing more strength lately. Then keeping an eye on bonds. These are TIPS or Treasury inflation protected securities, and then compare it with 3 to 7 year bonds. We had been going back up. In fact, we still might see a golden cross with this ratio. As a general rule, when this is going up, that means there's inflation concerns. That means that the market's worried about interest rates going up. Well, we were starting to come down, but now we've been going back up as interest rates have been going back up. But over the last, well, few weeks or so, we've been seeing this ratio coming down. And that would probably be more positive. We're trying to pick up the context to see, is the market actually changing its overall environment? If this continues to go up and the S&P goes up, okay, we're switching a little bit from what we were seeing earlier on in the chart. But if this continues to go down, we're kind of going back to what we were seeing before. Then we look at the long-term bond ETF, that's in blue, and then do a correlation with the S&P 500, which is in red. The longer-term correlation is not very strong right now. And you can see the red line's been going up as the blue line's been going down. Shorter term, it's improving, but still kind of more neutral right now, where we're not seeing a real strong correlation between them. And we look at the same kind of thing here with the QQQs to the long-term bond ETF, except here instead of blue, it's red. And you can see where the Qs have been going up, and for the most part, the long-term bond ETF has been going down. And so their long-term correlation is not really strong right now. And we look at the 10-year yield in the US, we subtract the German 10-year yield, and then we plot the US dollar index. The dollar, which is in a downtrend, has been just really strong lately. And we can see up here with the interest rate movement and then the rise of the dollar index that the correlation right now is pretty strong between them. So we get a little bit of insight of the interplay between currencies and whatever the yields are, specifically the 10-year yield. And we watched the 2-year Treasury yield where it had been declining, and that was helping the S&P to go up. It's kind of chopping around and going back up lately. This is also another reason why stocks have recently been under pressure. Interest rates were going back up, and I watched the 10-year probably the most, and it was going up. It got back over 4%, but the S&P was still doing well. Once it got up to that 4.25 area, that's when the market started to freak out. And that's some of the weakness that we saw in Friday's session was the 10-year yield was coming down, and it bounced off its 200-day moving average and started to go back up. And that's when stocks started to turn down. We look at the 10 to the 2 yield curve. I mention this in every daily video, but I don't show the chart. We're still above zero, which means we're uninverted or going back to being normal. But we're still inverted here with the 10 to the 3-month yield curve. And it's been well over 2 years now that this yield curve has been inverted. We're waiting to see if that's going to cross over again. And then I have a thing called possible positive scenarios. And I use a lot of the charts in the daily videos, but the ones that I don't use, I show here in this video. This is the percent of stocks in the S&P above their 200-day simple moving average. And I use this like an oscillator. And when we're above 50, we're positive. And that's what we're seeing right now. But we're not getting any kind of an extreme reading currently. Then we look at those stocks above their 50-day moving average in the S&P. Also use this like an oscillator. Even though we're declining, we're still above 50 here. And just to give it a little bit more context, we look at the mid caps, where this is also like an oscillator. Even though they're declining now, they're still above 50, and the small caps have actually dropped below 50. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I also post. I hope you have a great weekend, and I will talk to you in the next video.